Welcome everyone, another Financial 15. Today we're back to taxes, specifically looking at flow-through shares. What is a flow-through share? How can it reduce my tax bill? What are the risks? Lots of good information. You want to stick around.
Yeah, that's exactly what we want to start dealing with. We want to talk about flow-through shares today. And again, if you want to find out this video or anything else we've done on the tax segment, RSPs, anything else along those lines, go to our YouTube channel and subscribe. Become a big subscriber to our YouTube channel. If you want to find any more of this, also, you can go to our website at beckerorr.com or like us on Facebook. We're more than happy to see any of the questions that you have or show you any of the videos we've got. But today in specific, we want to deal with flow-through shares. What are they? How do you save tax with them? Where can I invest them? Where do I buy them? The whole 9 yards. Clint, start us off.
Yeah, we're just going to jump right into flow-through shares. Lots of information to cover because they can get a little complex. We're not going to go through every little nitty-gritty detail today. We're going to do an introduction to the topic, see how it can save some tax, look at a few details, an example, and also talk about the risk. Let's start with what is a flow-through share, starting with the perspective of the company. So why do companies issue these shares? Because it's a way for them to raise money. In Canada, there's certain sectors, you can see them listed on the slide: mining, oil and gas, renewable energy, energy conservation. All those sectors can participate in this project from the government, allowing them to issue flow-through shares, which allows them access to capital. They get more money in the door to finance their exploration and development projects. Often these are smaller companies, junior companies, often companies that have trouble raising money. So this program allows them to access some capital. Couple of details there. Why is it called a flow-through share? Well, the issuer, the company, can transfer their eligible exploration and development expenses. They can flow those through to the investor, and then the investor gets the tax deduction. We're not going to get to the details here. Simply list that there are a couple of types of those expenses. There's the CEE, Canadian Exploration Expense, and the CDE, the Canadian Development Expense. So quickly, company, why do they do this? Well, the government allows them to flow those expenses through to the investor for a tax break. Because of that, these small companies that often can't access capital can now raise capital. That's why the company participates. Kevin, why do investors want to own a flow-through share? What's in it for them?
Yeah, there's a variety of different things that go on with the investor on their side of it as well. As you mentioned, the big thing with some of these companies is they're junior companies. They have trouble raising money. So how do you entice an investor to try and buy into your company if you're small and they don't know much about you? Well, you give them an entire tax break off of what's going on. So when an investor puts the money in, they can deduct the eligible expenses to reduce their income. As you mentioned, it flows through to them. So if there was a complete write-off on one side for the junior company, that now goes to the investor because you put the money in there. Now, the investors may also receive not only federal income tax credits, but also provincial tax credits. So you may be able to sort of quote unquote double dip in that point, in that you're getting tax credits on both sides. So that can make it even more appreciable to you, and the fact that you've gotten money back for putting money in to help these guys out. And the tax deduction, of course, reduces your adjusted cost base of the investment as well. So, we're going to do an example later on, but depending on how much you put in, depending on how much is write off, you can have a very low cost base on this scenario, and it can help out with your tax situation personally for the investor going forward. And again, one of the things to remember is that this is a non-registered investment only. If you are only in RSPs, if you only have RIFs or TFSAs, this does not apply to you. It is strictly for the non-registered accounts that the flow-through shares actually work. But for the investor, it does give them options to try and reduce their taxes and get into an investment scenario at the same time that the government legally allows you to do.
Yeah, and again, we're just glossing at some of the high-level details here because there are lots of additional tax credits. It could depend on the deal, could depend on the province you live in. But the simple idea here, junior companies, trouble accessing capital, so they offer these big tax incentives, and that's why investors participate in these flow-through shares. What does a flow-through share look like? What's the structure of the deal? Well, often you put the money in, but there's a lockup period. You can't just put it in today and sell it tomorrow and get all these tax benefits. You have to leave the money with the company for a certain period of time. And it will vary depending on the deal. Could be a few months. Often it's a few years, and could be something in between. But there is going to be a lockup period. At the end of that lockup period, you'll get the money back. The details, again, will depend on the specific agreement, depend on the specific deal, but often at the end of the lockup, it's going to roll over. You could get a cash payment. More frequently, it rolls over into a mutual fund, and then you can sell that fund or keep that fund or do whatever you like with the mutual fund. But a key here is that at the end of the lockup, if you put $10,000 in up front, at the end of the lockup, it might not be worth $10,000.
No.
It's an investment. The value is going to change. So what you get at the end of that lockup will be dependent on the market value at that time. It could be higher, it could be lower, but that's the value that's going to roll over to the cash payment or to the mutual fund. So that's basic structure. We have this lockup, you have this rollover. But really a question here, Kevin, if people are thinking, all right, we're getting all these tax benefits, I get there's a structure. How do you actually buy a flow-through share?
Well, yeah, and that's a very important part to take a look at. As you mentioned there's a lockup period. And the rationale for the lockup period is what they don't want you doing. These companies are looking to get money so that they can utilize it to expand their company or use it for drilling or whatever the case may be. If you put it in and take it out 2 weeks later, this doesn't help them. So that's why there's the lockup. But buying these things, they've got to make sure that the money's coming in. They are constantly a new issue only. There is no secondary market where you're going in and buying a used flow through, because again, they flow through all the benefits to you initially. If you did it and the one guy gets the benefits and immediately it goes into a secondary market, well, there's no benefits going to guy number two. So they are always a new issue, never a secondary scenario. And to prove that you did buy a flow through share so that you can utilize it on your taxes, it's one of two ways. Either you're buying directly into the company themselves, which they may issue it and say, here, we are a gold company, we're a mining company, we're an oil company. We are selling directly to you on a new issue basis. You'll get a Form T101 statement of resource expenses so that the government knows you bought a flow through and you can write it off. Again, there are other options as well. You could buy what are known as a limited partnership flow through. They may have a variety of different companies under that new issue banner that they've put together in a basket. So they're offering you a basket of these things. It could be in the oil and gas sector. It could be in the metal and mining sector, whatever the case may be. For that, though, you'll receive what's known as a T5013 tax slip. And that, again, also proves you bought a flow through, but that you are buying this flow through and you get the tax deductions going forward. So again, remember, it is a new issue only. So when they come out, they have to be bought then. Once the period is over for the new issue or it's all sold out, there is no more for that. You'd have to look at a different option to be able to get it.
Yes, from a tax planning perspective here, if you've got a big tax bill and it's July, there might not be a flow through available at that time. Like they're only come in certain times of the year. They're only new issues. They're only available for certain periods. You have to keep that in mind. It's not like I can invest any day of the week in a flow through. There are only certain periods. So from a tax planning perspective, you have to keep that in mind. That's a lot of info in a short period of time. So we're going to do a quick example here. We're going to go through some couple of stages and intentionally break it down so you understand the upfront component, understand the rollover component, as well as the investment risk. So there's a few stages here. The first stage, we're in our example, quite straightforward. Bob lives in Manitoba. He earns $125,000. I only picked Manitoba so we can use those tax rates. If you're in Ontario, Alberta, same general principle. It's just the tax rate would be a little different. But our example, Bob in Manitoba, $125,000 is his income. In 2022, he puts $10,000 into one of these limited partnerships that buys a basket of flow-through shares. So Bob is going to get a $10,000 deduction on his tax return for 2022. So in Manitoba, in that income bracket, he's going to get some savings, $4,340 savings in tax. So he does that upfront investment. He gets that initial savings. That's the first part. Now we're going to go to the second part of the example here, Kevin, that deals with the rollover. How does that work?
Yeah, exactly. For most limited partnerships, it's never really a short period. It's usually a couple of years down the road. And as this example shows, we're looking at 2024 when the investment rolls over. So if you bought it in January of 22, let's say it rolls in January 2024, and it goes to a mutual fund. Now, at the time, let's say the rollover, his entire basket worth of these holdings is no longer worth 10 grand. It's now worth 9,000. But since he put 10 grand in originally and wrote the entire 10 grand off, his adjusted cost base has now gone to zero. That's an important point to remember. If you can deduct the entire scenario, your adjusted cost base has to go back to zero. So let's assume at this time, Bob takes the rollover and he decides to sell the mutual fund. He is now triggering a $9,000 capital gain. And of course, with capital gains, we know we're only showing half of what the gain is. So $4,500, and we're paying tax on that, which means that he's going to pay roughly $1,953 in taxes. Again, this is in Manitoba that we are dealing with. In different provinces, the rates may be a little different, but for this purpose of the example, 1953 is what he's going to pay in taxes. So that's where we're going. What's the next step that we have to look at, Clint?
Yeah, and that's a very key point there. We'll talk about the next step. But you mentioned province to province, really the tax rates will vary, at least for our example. But the key there is, one, he put 10,000 in, he's only getting 9,000 out at the end of the lockup period. We'll talk about that. Also, that cost base. You do the full deduction, your cost base essentially is going to be zero, which means we have a larger capital gain at the end of that lockup period. So let's put all those puzzle pieces together. We have the upfront savings, the $4,340. That was in 2022. Like Kevin just mentioned, in 2024, when the lockup period ended, he ended up having to pay a bit of tax, that capital gain. So in total, he ended up saving $2,387. Upfront $4,000, paid roughly $2,000 2 years later. You can see the savings there. But we have to look at the investment. These are investments in junior companies. There's risk involved. He put $10,000 in. He only got $9,000 back. He lost $1,000 on the investments. You can see the total gain there is $1,387. A pretty big tax savings, but then a loss on the actual investment. So he still came out ahead because the tax savings offset the investment. And this kind of sparks the conversation there, Kevin, of a couple of items, one of them being the break even.
Well, yeah, and that's a big one to look at. I mean, theoretically speaking, if you put 10 grand in and you manage to get 10 grand out at the end of it, that it was even, you're going to have some tax savings there. Why? Because what you've done is you basically turned income that you would have had to pay tax on into capital gain, which you have to pay tax on now, and you'd only show half of that. So again, that's one area to look at. But actually, the reality was going to be, what is your break even? Well, if you put 10 grand in, as we've seen, if you get 9 grand back, you're still saving $1,387. Theoretically, if you got somewhere in the neighborhood of maybe 7,000 back by the time you add in all the tax savings and the taxes that you have to pay plus what you lost, that may be your break-even number there. So you don't exactly have to get back your initial 10 grand to say, oh, well, it's a break-even investment. Because you've got all those tax savings and you've turned capital, or you've turned income into capital gains, you do have a little bit of flexibility to get what would be called break-even back.
Yeah, and there's a couple of points there. One, the tax bracket is key. The higher the tax bracket, the more your tax savings, the lower your break even. So if your tax bracket is, in one of the lower tax brackets, this is not a strategy for you. If you're in one of the higher tax brackets, might be something to consider. And then another item, and this is a big one, is the risk involved. These are investments, specifically investments in junior companies. In Canada, it means you're going to be in energy conservation and oil and mining and all those sectors. But again, junior companies, specifically junior companies that usually have trouble raising money and need these tax incentives in order to get investors in the door. So you have to be comfortable with the risk. Often these companies would fall into what I would call a high risk category. So you might get your 10 grand back, you might get less, maybe you'll be lucky to get a little more, but you have to be comfortable with that level of risk. Don't get blinded by all the tax savings. You have to appreciate there's a risky investment underneath of that tax structure. Anything else you wanted to add to that, Kevin?
Yeah, no, as you mentioned, I mean, that's the big factor to realize, that this is definitely not for the faint of heart. I mean, basically, you need a high income that you're maintaining. You need to be able to say that, okay, if I write it off, that's great. But if I lose the entire investment, it's not going to affect anything going forward, which is always a possibility anytime you're dealing with these penny stocks or junior mining and oil. So those are big factors to look at. Other than that, if there's anything else you need, please get in touch with us, chat with ClintonandKevin.com. We have done this at more of a high level. There are intricacies into each one of these things. We could talk for at least another hour on how flow-throughs work. If you have questions on that, please let us know. We may dive into that in another Financial 15, but we wanted to give you the big aspect as to what a flow-through is, how it works, how they save. Other than that, Clint, final words are to you.
Yeah, an hour-long presentation of flow-through. That'll put people to sleep like that. Well, we'll keep it at the high level. If you have more questions, get a hold of us. Until then, everyone stay safe, take care. We'll be back again soon with another video.